Hello and welcome back. In this video, we are going to learn about how to analyze the room profit and loss. So we have seen the step 1, 2, 3, where we learned about how that we need to export the P&L into Excel file, or we can key in the standard template is there. So you can change the figures every month and then you will get the formula. So you can formulate this percentage and the calculations, so you don't need to do it again and again every time. So and then you can just change the figures and then everything else will be done. Second thing what we learned was to calculate this variance column. So if the standard profit and loss statement of your hotel is not generating the variance statement, you need to calculate that so that you can compare the variances compared to last year and budget ready made. You don't need to calculate, use your calculator and waste time in calculating the percentages. The third thing was to calculate the flow through. Normally the GOP flow through for the hospitality industry is about 90% if it's a positive in rooms division, but if let's say it's 87% or the higher, in case of negative revenue variance or negative profit variance, the higher GOP flow through is actually a bad thing because it indicates that the expenses are not managed well. But the low if the room revenue variance is positive, then a lower GOP flow through will also reflect that either the revenue is not maximized or the expenses are not controlled well. Now, um, what are the steps? So the first step that we learned from the in the previous video was that we're gonna analyze the revenue variance and the profit variance. So now in this case, the profit and revenue variance is negative. So very first thing is to identify is what are the segments, what market source is causing the business to be down. So we're going to look at a market segmentation report which we discussed in other video, where we learn how to analyze each market segment, and then we're gonna drill it down to the business source, to the guest nationality, which we also learned in other videos, so that we know where is the shortfall and what we can do about it. So the market, you can discuss with the marketing departments and then fix the root cause of the problems, or to target those clients where the business is either at the moment is used to come but not coming anymore. And then the second thing is, in this video we are going to discuss about the expenses. So what we want to do here is, if the negative room variance is, let's say, 36% here, and compared to the last year is 30%, so whatever expenses are below this number, i.e. like 4, 12, those are the expenses which are causing the room revenue, the profitability to be impacted. So here you can see the last year profitability was 83% now, and budgeted was 85, but actual is 82, and the the GOP flow through is 87 and 91%. The reason being, whatever loss, whatever revenue we are losing, we are not able to save so much of expenses. So most of it is coming down as a result in the loss, as a result of the loss of profit. Ideally, when the revenue is too much low, then we should be able to manage the expenses and reduce the loss impact on the profitability. However, in the rooms division, in the hospitality, most of the costs are fixed. So in this case, you can see that the biggest cost in the hospitality in this company is labor, $5 million, $1.6 million commission. Then you have $3 million complimentary benefits, and then you have $1.2 million supplies cash, and then that's it. So these are the 4 major costs, and then you have some small costs on reservation, and then cleaning supplies, and then you have some laundry expenses, and then you have some TV movie expenses. However, most of the expenses are fixed. Like labor is fixed because once you hire the staff, you hire the staff already. You cannot you cannot terminate the staff just because in 1 month you don't have a business. However, if let's say that's why normally when we plan the manning, we are planning that if the business is seasonal, then we hire temporary staff more than the usual, more than, so that when if there is no business, when we know the seasonality is there, then we can terminate their contract, so that we don't really pay the contract staff when we don't have a business. Commissions are based on revenue. So in this case, for example, in this case, the commission last year was 230,000. Now this year is 1.6 million. What is happening is the last year revenue, sorry, the 1.8 million and 1.6 million. So we are saving 230,000. What is happening is the revenue is lost by 30%. However, the commission is down only 12%, which means that there are other non-commissionable business which we are losing more than the commissionable business. So we are paying higher commission in percentage term, which you can calculate. If we bring it down to the decimal points, then we would be able to see the impact. However, the this is not impacted here. So, but you can see the percentage is only 12% reduction, while compared to the revenue, which is 30%. And now the labor is only down by 4%, which means the most of the labor is fixed. So we are not able to influence the labor cost here. The reason being is it's fixed. Then the next big item is the complimentary services and gift, which is $3 million compared to 5.2 million last year, or 4.1 million budget. So here we are having a saving of 43% compared to the loss of revenue by 30%, which means that the hotel has been able to, to control the complimentary services and gifts, but compared to the budget is a different story. So it means that the budget was done to control the cost even more. However, the loss of revenue has reflected it, not so much of the significant savings here. The next big item here is the reservation fix, which is normally a fixed fee. Normally part of it is fixed fee, part of it is the variable fee, because you have to pay some channel manager fees and some booking engine fee, and then some fixed fee based on the reservation system we are using. So here the cost, the expenses are down by 21% compared to the revenue down by 30%. Here again, the savings are not that much. It means we have a high portion of fixed cost, especially like compared to the budget, where we are losing 36% revenue, but saving is only 3%. And then you have the supply guest, which is also a variable expense, highly variable expense. Here we are not that bad, because we are able to manage the expenses in the same proportion as the revenue drop. Now the next big item here is the TV and movie, which is mostly fixed. Even in fact, the compared to the budget is higher, but compared to last year is lower by 14%. Even though the TV and movie expenses are pretty much fixed in the hotels, because you have to pay to the channels, distributors, even though you don't have any guests in the hotel. So those are fixed expenses. So this is how we are going to analyze the expenses. So we see the items which are higher in percentage and lower than the variance in the hotel. Variance in revenue comes especially when it's negative, and if the variance is positive, then we will see items which are lower which are higher than the revenue percentage, so that we can identify what are the expenses to be controlled. So this is how we are going to analyze. So now in the next step, what is you're gonna have assignment of your hotel to and analyze your own hotel's performance, and then submit to me, so that we can see what is your understanding. The most important thing here is to see the details. So if you say that, okay, the expenses are not that down, so what are the details? What expenses are there which supposed to be controlled but which are not controlled yet? And then you need to come up with the creative ideas on how we are going to control the expenses, or to increase the revenue. Thank you very much for watching this video.